Estimated taxes can feel like a no-win situation. You either pay too little and you're hit with fees and penalties and interest, or you pay too much and you provided an interest-free loan to the federal government. And for that reason, that's why business owners need to think differently about taxes. First, some ground rules. One of the things that we'd love to start on with our business owners for their estimated taxes is the safe harbor rule. What the safe harbor rule says is that we are going to set aside 110% of your tax liability from the prior year. What we mean by that is, let's use round numbers as an example, you make $200,000, you owe $40,000 a year in taxes for last year. We would set you up on quarterly payments for $11,000 each quarter. The reason why is that's 10% higher than previous, and that prevents you from owing any penalties or interest when we're calculating that final tax due. Now, if you have a killer year, you made 300,000, right? And taxes are up another 50%. So let's say in that example, instead of being at 40,000, they're at 60,000. Yes, we'd have to make due and make it right by the government by April 15th. But those quarterly estimates, because they're 110% of the prior year, it keeps us on track to avoid any penalties. The second thing that we need to think about with business owners, which is fundamental to how you're being taxed, is the structure of your company. So if you're a C Corp, you're fairly similar to how you were back as a W-2. So use the example of you making $175,000, you're going to pay ordinary income tax rates. Say it's about 22%. Now, what gets a little bit different is because you are both the employee and the owner, you're going to pay an extra 15.3%. That's often referred to as the self-employment tax. It's the Medicare tax. Both the employee and employer pay it. If you're an S Corp, it's different. You're only paying that self-employment tax on your payroll. That's why a lot of people opt for an LLC structure and Subchapter S, because by doing that, your payroll is getting taxed at the ordinary income rate plus the Medicare premium of the 15.3%, the self-employment tax. But on the profits that you earn, we're only paying the ordinary income rate. But for both, whether you're the C Corp or the S Corp, remember, the profits of your business, we will owe estimated taxes from that. So a lot of people who own S Corps, they think, well, I don't owe estimates because we withhold on my payroll taxes. Unless you're over withholding on your payroll taxes, you will still have estimates that are due. And the third and final thing on how business owners need to think differently about their taxes is to take into consideration the entirety of the rules. So starting with the 2017 Tax Cuts and Jobs Act, we have what's called SALT, state and local taxes. There's a limitation as to how much you can deduct on your federal income tax and how much you pay in state and local taxes. So what many states have done as a kind of workaround around this, which has been blessed by the IRS, is called PTET, pass-through entity tax. And pass-through entity tax is where the company pays the taxes from what the company made. So what that does in effect is, let's use an example of the business makes $200,000. It pays the state tax rate of 5%. It'll pay the state tax of $10,000 from the business. Now, that is instantly 100% deductible on the federal level. Whereas, let's say you had a nice house, a nice income, your state and local taxes are capped out at $40,000. So for many of our clients in, say, New York, California, Illinois, and some other states, you hit that $40,000 mark because of the cost of living in those states. Now, by having the business pay the state income tax, it instantly becomes deductible from what the business makes. That is now deductible at the federal level. So again, as a reminder, the three ways that business owners need to be thinking differently about taxes is 1, safe harbor rule, where we're able to set up at 110% of last year's withholdings. 2, how your business structure directly impacts your personal tax rate. And 3, taking advantage of PTET as a business owner, being able to take advantage on how taxes are being paid so you minimize your total tax liability. Thank you so much.